What the bank says you can afford and what you actually can afford are two different numbers. Every home buyer knows that. But here in the South Sound of Washington, there's a third number, one that most loan officers won't tell you about, and it can change your buying power by about $125,000 or so. And if you happen to be a veteran or active duty, even more. Same buyer, same income, same down payment, just a different loan product. Today, I'm going to show you exactly how it works, and we'll figure out which version works best for you. Okay, let's get clear on the three numbers, because most of the mortgage advice that you get from loan officers just talks about the first two. Number one is the bank's number. This number is what you qualify for, and what it's called is a debt-to-income ratio. Your monthly debts divided by the gross monthly income. Banks have specific caps. Conventional loans, usually between 45 and 50%. FHA can stretch up to 56. USDA caps at 43. You get a pre-approval and the bank tells you what you can afford a house up to X. That's the bank's number. The second number is actually what you can afford to live with. The bank's number tells you what you can pay every month. The real number tells you what you should pay every month if you also want to take vacations, save for retirement, fix a leaky roof, and not worry or stress out about what interest rates do in the headlines. That's the difference between being qualified and living comfortably. Most affordability videos stop right here, but there's a third number, and this is the one that almost nobody talks about. The third number is what changes when you pick the right loan product. Because here's the thing, affordability isn't one number. It's not even two. It's actually 4 or 5 different numbers, one for each major loan type. And the difference between the highest and the lowest for the same buyer can be $125,000 in this market for purchase power. And for veterans, it stretches even further. Let me show you exactly how.